Is investing in an IPO or initial public offering profitable? I will answer that question in this video by presenting the statistics of the historical performance of IPOs over the last 40 years. The statistics I will present are based on Professor J.R. Ritter's research paper, where he analyzed the performance of IPOs in the US stock market over the last 43 years from 1980 until 2023. Additionally, I will also discuss the findings of research by Nasdaq Economic Research led by Chief Economist Phil Mackintosh. If you are interested in reading those articles yourself, I have added links to them in the description below. Whether investing in an IPO is profitable or not depends on a host of factors. Some of the major factors include your investment time horizon, which is short-term or long-term, the chances of getting the IPO allotted, the size of the company, its profitability, and whether it is a tech company or not. I will talk about the investment performance based on each of these factors and explain how they can affect the returns of your IPO investment. Some of the findings that I will discuss might surprise you and could possibly change your perception of IPO investing. Just like any investing activity, investing in an IPO involves risk. However, if we are well equipped with data, we can reduce the probability of making a bad investment decision. With that said, let us get started and learn more about IPO investing. My name is Kanak and welcome back to my channel. For more such content, subscribe to my channel and show your support by liking the video and dropping your thoughts in the comment section below. Alright, before we jump into the performance of IPO investing, let us do a crash course on how an IPO works, because that will help us understand the IPO allotment process and how it prefers large institutional investors over retail investors like you and me. An IPO or initial public offering is a process through which a private company becomes public by raising money through the sale of its shares to retail investors by listing on the stock exchange. To list on the stock exchange, the company hires investment banks such as Goldman Sachs or JP Morgan. The job of these investment banks is to market the company to large institutional investors to sell them the shares before listing on the stock exchange. Through this process, the investment banks gauge the demand for the shares and determine the right price at which to list the company. When IPO shares are allotted before listing on the stock exchange, institutional investors get the first preference, while retail investors like you and me receive shares at the final price set based on the demand from the institutional investors. There are several reasons why institutional investors get first preference. The first is regulatory requirements mandate that a certain percentage of IPO shares be allotted to qualified institutional investors. They have the expertise and resources to assess the price of the shares, and they can invest large amounts, providing credibility before the company goes public. Because retail investors are not the first order of preference, we often do not get allocated any stocks or only receive a partial allocation. This is especially true for highly popular IPOs with higher demands than the available supply, which works against retail investors since IPOs with higher potential for success have a lower probability of allotment. Therefore, it is important to remember that the IPO allotment process might not necessarily work in your favor. Now, in this process, two important terms to remember are the offer price, which is the price at which the IPO stocks are allocated, and IPO pop, which refers to the situation when the price of the listed stock closes higher than the offer price on the day of listing. Now that we understand the IPO process, let us talk about the chances of profitability for an IPO investor. The chances of making a profit from IPO investing depends on a key factor, whether you are a short-term or a long-term investor. For this discussion, I'll define a short-term investor as someone who wants to get the IPO stock allocated and sell them at the end of first day of trading after the IPO pop, meaning you aim to sell the stock after it jumps on the first day. On the other hand, a long-term investor is someone who buys the IPO stocks on the second day of listing and holds it for the next 3 years. Let us first talk about the short-term investor. According to J. Ritter's data, IPOs closed about 18% higher on an average on day one. This means if you were allotted an IPO stock at $100, it would typically rise to $118 by the end of the first day. However, not all IPOs jump on day one. In fact, 31% of IPOs actually decline by the end of the first day. This means 1 out of every 3 IPOs closes below its offer price on the first day. In 2020, during the COVID-19 market boom, IPOs saw one of the highest jumps on day one at almost 40%, and only 25%, which means 1 in 4, declined below the offer price on the first day, which was lower than the historical average. The performance of an IPO on day one also depends on the size of the company. According to Nasdaq Economic Research, mid-sized IPOs, companies with market capitalization between $1 billion and $8 billion, have significantly higher first-day gains than smaller companies, which means companies with less than $1 billion in market capitalization. Larger companies with market capitalization over $8 billion have even higher first-day gains than both mid-size and smaller companies. An interesting fact is that the first-day gains are typically higher for companies that experience greater demand for their shares relative to the number of shares available for sale. This means that the more an IPO is subscribed, the higher the first-day gains tends to be. The next surprising fact is that unprofitable companies have an IPO pop of about 26%, nearly double that of profitable companies at about 13%. This is because investors value potential future cash flows more than the current profitability. Many of today's profitable giants like Amazon and Netflix were unprofitable when they first IPO'd and were still expanding their markets. The third critical factor is whether the company is a tech company or not. Tech companies experience 31% jump on day one, nearly 3 times the 11% jump of non-tech companies. Now that's a lot of information, so let me summarize. If you are a short-term IPO investor looking to sell the shares by the end of day 1, there is 2 out of 3 chances you'll see a positive gain. Your chances improve if you invest in large tech and unprofitable companies. However, remember that IPO allocation isn't always in your favor. For popular IPOs, you might not get the shares you want or only get a partial allocation. Now let's break down the returns of a long-term IPO investor. We will firstly talk about 1-year returns of IPO companies and compare it to the market index. Small companies are compared to the Russell 2000 index, while large companies are compared to the S&P 500 index. According to Nasdaq Economic Research data from 2010 to 2020, by the end of first year, 50% of IPOs underperformed the index by more than 10%, meaning 1 in 2 IPO stock did worse by nearly 10% when compared to the respective index. However, 34% of IPOs outperformed the index by 10%, meaning 1 in 3 IPOs beat the index by 10% or more at the end of first year. Over the long time horizon, the performance worsens. By the year 2, 60% of IPOs underperformed the index by 10%, and by year 3, 64% of IPOs underperformed the index by 10%, meaning 2 in 3 IPOs do poorly by about 10% compared to their index. Still, 29% of IPOs beat the index by 10% or more by the end of year 3, giving you about a 1 in 4 chance of outperforming the market by more than 10%. If you manage to get allocated the top 10% of IPO companies, your investment could triple in value by the end of year 3. Now let's talk about the company size and profitability. Large companies, which means companies with more than $100 million of sales at the time of IPO, show higher positive returns if they are unprofitable. Smaller companies, which means companies with less than $100 million of sales at the time of IPO, tend to have negative returns over 3 years. However, profitable small companies perform slightly better, which means less negative returns than unprofitable small companies. Again, it's a lot of information, so let me summarize. If you're a long-term IPO investor, more than half the time, your returns will underperform the index. However, there is a 1 in 4 chance of significantly beating the index over the course of 3 years. On average, large and unprofitable companies perform better than small and unprofitable companies over the long term. That's all for this video, and if you like the video, then subscribe and hit the like button. Thank you.